But with what all is happening in the world, it's time to return back to the markets. We're deep into the red, tracking the rest of the global markets after the red hot inflation data of 8.6% was released on Friday in the US. Dinshaw Irani, now live with us. Dinshaw Irani, thank you so much. What do you make of this market? And I'm going to put it as crudely as I can because I think that's what our viewers will want to know. What's the big advice with the sell-off, the big correction that we're seeing this Monday?
Well, the biggest advice by the morning, and thank you for having me on your show. Nothing good about the morning, so I'm sparing the good part. But anyway, having said that, the sole advice is don't panic. These are the times that will test a very astute investor. And the fact is that India, so the data points coming out of the US are very scary, right? I mean, 8.6% inflation. They haven't seen it in the last 40 years as such. So their central bank doesn't know how to deal with this. I mean, they're in an uncharted territory right now. But in India, having seen our inflation, we are at 7.8, I believe. I mean, the last inflation print was that, and probably I think today or tomorrow they'll be coming out of the May print, which I believe is lesser than that because of the way we handle crude domestically. I mean, we are not passed on that to the consumer. So the fact is that India is on a better footing in managing these kind of high inflations, right? And secondly, one more thing that works in favor of us is that commodity prices, crude apart, is coming off to an extent. So you may see inflation. Our in fact feel is that inflation will peak out by September or so, and then probably start tapering down. So that'd be good news for our central bank as such. So let's hope people don't panic and probably use this opportunity. Yeah, obviously the weak sectors and stocks that one is not comfortable with, one should be out. Should have been out long back. In fact, that's what we've been advising. We have been cautious all along since the beginning of this year, talking about the calendar year as such. And we continue to be so, but that doesn't mean that we do not work towards identifying opportunities to pick as and when there's panic in the market and we get our prices of comfort levels of getting into the stocks.
You had, of course, reduced your cash position, Dinshaw Irani. I remember the last time you were here, you were talking about cash going down from 25% to 10%. You gave us some idea of the kind of stocks that you'd be looking at. A jewelry stock, PVR, if I'm not mistaken, as well was another one. Vedant Fashion was another one. But now, with the scary headlines that you've seen coming out of the US, on Wednesday, we'll know if the US Fed is going in for a 50 basis point rate hike, 75 basis rate point hike, what kind of liquidity is going to be sucked out. Can I ask you, how are you going to make volatility your best friend?
Well, that's what the point is, that the US, if anything, the data points coming out of there have only been worse as such. And that's what making us more cautious now. In fact, we thought things may improve because having seen the sound bites coming out of the US initially was that the inventories were not moving. In fact, the warehouse spaces were empty and stuff like that. So we thought that demand was coming off, and probably to that extent, there'll be some compression in inflation rates in the US itself. But that, I mean, rather drop in demand and leading to compression in inflation. But that's not happening in a sense. So we're being cautious still. I don't think we're going to use our cash reserves very fast to get into stocks. But yeah, having said that, you look at opportunities. You always find opportunities in the market, either to buy or sell, and that's what we'll be looking out for. We've been doing this for last 25 years as such, and I think we have what it takes to stand this out, I suppose.
Hi, good morning. Avan joining in as well. Just a short while ago, we were interacting with another market guest, Ajay Srivastav, who said that he would call banks a qualified loot, and there's a mega profit-making opportunity at this point in time in banks. Do you concur or do you beg to differ?
We've always been very bullish on banks, Avan. I mean, in fact, private sector banks is what we've been standing along with and for a while. And our belief is very clear that in a rising interest rate scenario, the private sector banks, rather the consumer-facing finance companies or banks, private sector, which are mainly your consumer-facing banks, should do very well. Their NIM should increase. given that their lending rates are straight away adjusted for, and we've seen that in the past. I mean, all the banks have been announcing 40, 50 bips kind of expansion in their NCLRs and stuff like that. So obviously, this is going to be a winner in the making going forward. So that's why we are, as I said, opportunities. Maybe this is one of the areas that we are looking at as such.
Right. Dinshaw, much as keeping a shopping list ready, it's also what is it that you would avoid in this new regime after the sell-off that the markets are seeing. So what are your top avoids?
So there are still pockets of frothiness in the market. Though overall, one must say that India's valuations have come back into par with the last 10 years, given these corrections and obviously the healthy growth in earnings that one saw in the March quarter also. So as a result, valuations are at par with 10-year averages, but that's India standalone. Unfortunately, in the region, the markets have corrected much more than India has, and as a result, our premium to the region has, if anything, remained quite high as such, and that's why this constant selling from FIs, because they see that, which we don't. We sit in India and look at our Indian stock per se, but they look at the globe as a whole. So having said that, there's still pockets of frothiness in the market. I mean, wherever which are directly impacted by crude as inputs, those areas are going to be really the one which one should be worried about. Basically, we're talking about the paints industry per se, where it's obvious that crude is going to create an havoc in the input prices. And already, I mean, you're seeing today also, I believe, Asian Paints is taking a price hike, but there's a limit to which a consumer can absorb these hikes as such. And that, I think, limit has been reached already. Secondly, one more thing that one should avoid is those driven by the commodity prices. I mean, the consumer durable part, which is consumer facing per se. There also, they've not been able to pass on the consumer price, the input prices to the consumer. So it's obvious that one should avoid those because one may see some compression in margins there too. So these are the kind of stocks that one should avoid. High valuations would be another area that one should be looking away from.
Dinshaw, I know Vedant Fashions has been an erstwhile favorite. Tell me, in this decline, would you be looking at adding positions? In fact, not just Vedant, anywhere else in your portfolio?
So we, as I said, that we always be looking out for opportunities. Maybe we'll wait it out if the market correction continues. But our analysis shows that these are the times when one should maximize their returns by slowly nibbling at the markets and probably spreading their investments out. So maybe we'll be doing that. Who knows? So I'll leave it up open right now.
Dinshaw Irani, the bad, scary headlines that we're getting from the US, rate hikes that are going to be taking place as well. Where will this leave your belief, faith, and conviction in large cap IT stocks?
Yeah, so good you asked that question because we've been cautious on IT for a while now. In fact, we've been trimming our positions. We started trimming in December itself. And we've halved it literally to that extent. But still, our feel is that there are two things which will impact IT. One is obvious that if a recession or the slowdown hits the US coast, it's obvious that the Indian IT will not be insulated from that. In fact, all the discretionary spends will go away. So the ones in ER&D and all that will have a tough time managing as such, which are more of the mid caps and small cap IT names. The large caps too will suffer, but our call is that the growth rates will be better than that of the pre-COVID times. But that still doesn't say much because the valuations are far higher than the pre-COVID times. Yeah. Having said that, one has to be cautious. The second one, which is going to impact IT, is obviously the input cost inflation. I mean, you've seen that the demand for IT engineers has moved up quite sharply. Maybe that'll ease out with the slowdown, but still the step up in the pricing, manpower pricing will be there. And as a result, it'll take a while for them to absorb. So these two factors are going to impact. So one has to be very clear in this, avoid the mid cap, small caps in IT space, even the large cap, be very specific, be very careful, be very cautious in what you're looking at.
So, Dinshaw Irani, tell me one thing. You have traditionally stayed away from energy, coal power type stocks, right? But with the new world order that we are in, a lot of investors may be looking for what we call to be the value stocks. So, let me ask you in a different way. How are you fortifying your portfolio against inflation, the red hot inflation, the fastest pace of inflation that we've seen since 1981?
So, okay, since you asked me that question, our call is very clear that inflation, we are looking at peaking out in September itself. Even with the crude at 120, you'll see that the inflation tapers down. It's purely the base impact which will work out in our favor. Having said that, it's not new that India has seen these kind of inflation levels. I mean, we've been fighting this for a while, though we haven't done it in the past few years as such. But we've seen high inflation, and our bankers are quite apt at managing this kind of a scenario. So our belief is that India will probably, face this storm quite handsomely as compared to what the US would do, because they haven't seen it in 40 years, as I stated earlier. But the fact is that India will be much more on the stronger wicket. Having said that, one more thing that we need to do is that when inflation is rising, what is driving that inflation? It's obviously demand. And with US and China accounting for a quarter of the global trade, if you see the slowdown there, it's a matter of time before you see the demand for goods and services coming off. And as a result, commodity prices will correct, which you've already seen in some of the commodities, except probably crude. So if that continues, you'll see again inflation coming off. So I don't think we're that panicking right now. Yes, obviously, if US takes a 75 bips hike, all bets are off the table on 15th, I believe. But that is like, I think, an outlier scenario. I don't think that will work out as such. Hope not.
The 15th night is when we're going to know, Wednesday late night for us in India, what it is that the FOMC decides to do. If it's a 75 basis rate hike, then Sharani is saying all bets will be off the table. Nifty still trading below 15,800. You've got the Sensex at 52,789. Thank you so much, Dinshaw Irani, for being live with us today and for helping our viewers understand the market construct and how they can try and at least befriend volatility, even if they can't make volatility their best friend. We'll take a short commercial break, ladies and gentlemen, but stay tuned. We'll be back in a few minutes.